Well, hello and welcome to Global Mantra Market Outlook 2015, a special series that we bring to you each year from the City of London, speaking to a lot of prominent money managers and market speakers about their outlook into the new year. My guest today on the show is Christian Keller, who is Head of Emerging Market Economics at Barclays. Christian, it's great to have you on the show. Thanks very much for taking out the time. My first question to you is, how are you mapping the EM region for 2015 from an investor perspective? What is it that investors are going to be watching out for within EMs?
2015 is probably not going to be an easy year. I mean, what we are probably still missing is, the growth momentum or reform momentum, with a few exceptions that people look for when they decide where to allocate capital. At the same time, one has to say that it probably does remain a relatively attractive environment for carry trades. We see global disinflation, we see low inflation in the core markets, and that has kept central banks from hiking. Actually, they have increased their unorthodox monetary policy in Japan. We expect more to come in Europe from the ECB. And even though we do expect the Fed to start hiking in the middle of next year, we anticipate a very, very gradual increase, and we don't really think that US Treasury markets will aggressively react to it. And that creates an environment where it may not be appealing to go into emerging markets from a growth perspective, but they still have a much higher yields on average than developed markets, and that typically, once valuation reach a point where they become attractive, people still go in.
Yeah, but you were talking about how emerging markets will not be that influenced by the momentum of money, how it's going to be very, very individual and macro-driven. The decision on part of investors to allocate incrementally in emerging markets.
I think that's it's an important aspect, and I think it's a relatively new aspect. In times of really, I don't want to say crisis, but in times of situations of stress, when we had the taper tantrum, for example, you see really everyone running for the exit, going in one direction. All the assets, and particularly in emerging markets, are completely correlated. That has now changed somewhat. What you have seen, probably starting already to some extent in 2011, but then accelerated in mid-2013, is an exodus of retail investment into emerging markets. And retail money is typically the money that's very flow-driven, and that correlates everything. It's people buying emerging markets on headlines of, emerging markets taking over the world, are growing very faster. They saved the global growth in the 2009 episode, etc. This money has gone out. What has come back in and what has increased since is institutional money. That money is more strategic, and that money is much better in picking what asset class they want to be in, what countries they pick, etc. And that's why I've seen a lot of divergence actually in performance between asset classes, different asset classes in EM, and also between different countries. And that what we believe will continue in 2015.
So which are the regions that you're banking on in 2015? And within asset classes, do you think EM equities will continue to do well, selectively that is, or there will be an opportunity in EM bonds?
Yeah, that's a natural next question, right? Then where do you think is the value? I mean, first of all, in emerging Asia, let's keep China outside for a moment. Two things come together. It's actually when I said, we have weak growth. Actually, emerging Asia, India, Indonesia, Korea, we do have good growth momentum. Yeah. And on top of it, you had elections in India and Indonesia, which brought governments into power that are perceived by the investors to be reform-oriented. So you have two things coming together. That's why in general we are quite optimistic on Asia, probably across the board, on currencies and also on local rates. Credit. On equity, selectively, yes. I mean, India had a fantastic year, and one has to say, that is a sign that investors do care about individual stories. Sure. If you look at emerging market equities overall, you look at the risk premium, for example, it is now no longer that appealing. It is now at a point where it is similar to developed markets, and then those investors who looked at broad MSCI performance of emerging market equities probably don't find it that interesting. And that's in stark contrast, by the way, to the beginning of last year, or of the beginning of this year, when everyone had decided to really hate emerging market equity. The the risk premium, the difference in the risk premium between emerging market equity and developed market equity was very large.
Very large, yes.
And it was a very good investment if you had gone into emerging market equity in the beginning of the year, all the way till the end of the summer. And then in recent months, we've seen, of course, a lot of money retreating from emerging market equity again.
In the few predictions that you're making for 2015, do you expect one of them to be a big dollar rally in extension to what we've already seen so far?
Yeah. We do think the dollar is going to continue to rally.
Is there a target internally that you see?
Yeah, we have a target which is, I think, 110 in 12 months.
110?
110 to the euro. So,
okay.
It would be
on the dollar index?
117 against the Japanese yen.
On the dollar index, that is.
No, I mean, the forecast we do against various currencies. I mean, but on the index, if you think euro and yen are large in the index, so
Sure.
that means a significant continues. We highlight, however, that is mainly really an appreciation against those two core currencies, but it will affect emerging markets. A lot of the investors are dollar investors, and it hurts them if they, if they are invested in emerging markets and their currencies depreciate. But emerging markets have depreciated a lot against the dollar already. You must imagine. I mean, the depreciation has started already in the middle of 2013.
Yeah.
Fundamentals have improved. Current accounts in some of the vulnerable countries have come in a lot.
Yeah.
So, we think there will not be that kind of excess that we've seen during the taper tantrum. It will make flows difficult.
Yeah.
But it's a well-announced hike by the Fed if they hike in the middle of the year. We've been talking about it. Markets are prepared. The moments when it hit markets the worst was always the moments when there was a big surprise. 1994 was a huge surprise, and then you had this massive withdrawal from emerging markets. We think now it's coming in much more gradually. It will be volatile, but it will not be. The fact that the Fed hikes does not mean you have to stay out of emerging markets
that's
fully.
not a given stance. And do you think the market is prepared for a scenario where this accommodative stance of the Fed is likely to continue through 2015? And how will the markets take to that?
Well, first, I would say our call for first hike in the middle of next year, in June, is not shared by the market. If you look at what U.S. Treasuries are pricing, they're pricing a hike towards the end of the year.
Yes.
First. If markets would become even more dovish than that, I think that is possible. Even though we see that hike in the middle of next year, if you look at our forecast for 10-year Treasuries, they are just at 285 or so by the end of next year, which would be a very gradual increase from where we are now. So we actually do believe that even if the hike takes place, the back end of the curve will be relatively well anchored. And the question is, under what scenario would markets believe that the Fed will not hike? Is it one where we really see, let's say, a crash in China or so? If you tell me that is the reason for the further delay of hike expectations, that would be a global negative, and it would be an emerging market negative without a doubt.
Sure.
If it's one where somehow the US continues to grow, but headline inflation is relatively weak, so the Fed decides to postpone, markets would probably take this as a positive, as long as US growth is good. And you could actually be in a scenario where that is not that bad for emerging markets. So the reason matters, right?
Yeah, absolutely. But within emerging markets, since you highlighted some of the names, what's a broad view on how investors would look at the India and China story?
I would say at the moment the India story is probably a bit easier to sell, because it's one where you have a path of accelerating growth. You have everything in place that looks set for higher growth, inflation to come down, helped by the low commodity prices. Our long-term scenarios are quite favorable. If the fiscal adjustment happens, we see household savings to grow. That helps you to finance growth inside the country, structural bottlenecks being addressed, etc. So it all looks a story where, there are some ifs, but, it looks towards going back to growth 7 or 8% as we had, last decade, average we had 7.6 or so. We think we can go back to that, right? With lower fiscal deficits and lower inflation. In China, growth will have to come down. It will have to come down further. We forecast that growth next year will be 7%. This year we think it was going to be like 7.4 or so.
But as long as they keep 7%, is that okay?
I think right now markets are actually more pessimistic. We have some surveys we do around this time, and when you ask people about one of the biggest risks, people see a negative growth shock to China as one of the bigger risks. And a lot of people, I think, have more a 6 handle as a forecast. Not necessarily maybe the economists in the market, but if you talk to investors, they see growth probably slowing below 7. That being said, growth is not the only driver. As long as people feel the government is in control, given the fact that you have a closed capital account, and as you open the capital accounts, for the first time foreign money can go into certain investments and participate, that itself is a very idiosyncratic investment story that could still play out, while the economy as a whole is transitioning towards lower growth.
For money which is looking at finding its way into India at these levels, you see rates going down in India, and simultaneously within that quarter, or maybe 1 quarter apart, you have rates going up in the US. What would that mean for the currency situation? Because there would be a favor towards the dollar then, and we could see some pressure on the local rupee. Or do you believe that there is a stronger view as far as domestic fundamentals in India are concerned, and so the rupee would be able to withstand a strong dollar rally compared to some of the other emerging market currencies?
Look, I think it would be a bit light-minded to say that one really believes if there's a general sell-off in EM currencies, the rupee can entirely go the other way. But I think what we've seen already this year and last year, withstand relatively. I think it could outperform other currencies. Frankly, for example, our equity our FX strategists, they recommend not to be long Indian rupee against the dollar, but they say be long against the euro. In principle, those are 2 trades, but if you're a currency investor, you get more bang for your buck if you go long Indian rupee and then do the parallel trade, shortening the euro against the dollar. You get the higher carry, and you get probably outperformance of Indian rupee against the euro. So it gives you more than you just short the euro against the dollar. Okay. But no doubt, if the Fed changes their communications, you see the short end of the US yield curve going up. Typically that leads to volatility, and typically, at least initially, that leads to currency weakness in emerging markets, often across the board, right? Okay. But the recovery of the fundamentally stronger currencies is often then relatively quick. I think this is in a way what could happen again in 2015.
But as somebody who studies emerging markets across the board, you believe that India would continue to stand out as a compelling investment story, whether it's in the equities segment or whether it's for fixed income, some sovereign bond in India. They look like attractive investment opportunities still relative to other emerging markets?
I think so. I think in particular also for, as I mentioned before, for institutional investors who have a more strategic view. Think of it, if our forecast now is that India is moving to a current account deficit, probably going forward between 1.5% and 3%. It will not, this year it may touch even below 1.5%, but it can go up. In a country that is has a lot of investment to do, that had the kind of demographics of India, is actually probably normal to have a current account deficit, right? But if it's 5%, as it was in 2012, then it starts becoming an issue. 1.5 to 3 is probably something that markets can live with. You have, I think, good potential for ratings upgrades. If the government fulfills some of those targets on fiscal space, current account lower, grows better, I would assume that we first go probably relatively soon in 2015 to a positive outlook, and then we could see upgrades in the next 2 years, maybe 2, not 1.
The interesting thing there is most investors believe that rating agencies are mostly behind the curve. So a lot of the story is already out there to be made money on before the rating agencies move. Do you still think that if somewhere in 2015, if India sees a ratings upgrade, that would signal a further up move for the market, a further opportunity to make money in India?
I mean, we currently have Indian credit as an overweight. It depends, there's a lot of studies in the run-up to an upgrade. Typically equity markets anticipate it best, and then there is a little bit of this buy the rumor, sell the fact that typically once it actually happens, sometimes valuations come down a bit. But as I said, if you see it longer term, if you believe after the first upgrade, the language of the rating agencies is such that you can think there's actually room for another one. I think India is at a point where if that structural transformation happens, it's a multi-year story. It's not a quick tactical game. I think in 2015 we have a lot of tactical games to play when suddenly inflation drops somewhere and news comes out. But we see India more as a longer term story, which is not a it's not a secret. I think it's well announced, but that shouldn't prevent it from playing out.
In the different classes of investors, we just had, the Norway Wealth Fund talk about how they've increased their allocation in India. When, such a marquee name talks about taking a long-term call in India, in your dialogue with a lot of investors from different classes, do you get a sense that more and more investors are thinking on those lines of actually increasing absolute allocations to India at this point?
I think India, typically these decisions are never made on one country. I mean, they may named India, but they probably chose a number of emerging markets. I think India, as I said, at the moment is the most compelling story. As I mentioned earlier, we have a situation now where the money that's flowing into emerging markets is more institutional money. It's sovereign wealth funds, it's pension funds, and they really, it's not that they don't care about their month-to-month performance and they don't want to be down on the year, certainly. But they do not really move that much by headlines. They look at things, growth dynamics over, a longer time horizon. What are the debt dynamics? If you, for example, if you look, nominal growth in developed markets is very low. Debt ratios are very high. This will stay for a while. While in emerging markets, at least in public sector debt, India is actually not the best example. The debt is relatively high, but in generally, debt is way lower. Nominal growth is still way higher. So that means the dynamics there, if you take not the next year, but the next 5 years or so, is still quite good. And these funds also think, what is my allocation that I have now compared to actually where global GDP is being produced? And even with a slowing China, a higher and higher share of global GDP is produced in emerging markets. The asset allocation is still completely tilted towards developed markets. And you read headlines about how much money has gone into emerging markets. It's still minuscule if you look at it on a global scale. These markets are much smaller. That's why it's justified. But as again, if you think strategically, these markets will grow over time, not only in the real sector, but also in the financial sector. And that's why these funds are making strategic allocations. And back to your very initial question, yes, I've heard investors in a way looking at this. India is an off-benchmark investment in bonds. They're not in the benchmark yet. And they do want to diversify into...
They find the Indian bond attractive at current yields. How much does a rate cut really then help revive growth? And when do you see growth revival happening in emerging market economies, if it does sometime in 2015?
It's a very interesting question, because I think at the moment what is holding back emerging markets is not necessarily that they have high interest rates. What happened in emerging markets over years is you had also in India already a very rapid credit growth, and now the leverage ratios of households, etc., of banks that are higher. And what's lacking really is still the demand from developed markets. So I said developed markets are doing a bit better in growth momentum, but overall global trade is down. And that is something where emerging markets are suffering, because typically a lot of there's some intra-regional trade, but typically it was from emerging markets to regional to developed markets. And even though exchange rates are weaker, they're still not exporting more. And this is not because of it shows you that it's not about competitiveness, it's simply a lack of demand. So I think export demand is more important for emerging markets at the moment than actually cutting their own interest rates. I think with the strengthening in the US and hopefully also Japan and Europe over time, that should help emerging market exports. But I would still say, look, banks and the financial sector is helped if you lower the interest rates. So, you do create a more healthy financial system, a more robust financial system. And I think that would help India, and then it allows corporates who do not have access to global financing to finance themselves cheaper. I think it still has an impact.
Okay, so before we wind up the discussion, just want to get your sense, stepping back a bit, what are the top 3 themes in emerging markets that you think will definitely play out, according to you, into the new year?
I think
ideas or investment themes, a trend perhaps, top 3 trends that you think will have an impact.
Well, first of all, which we already discussed, I think one has to think, if one goes into any local currency asset, what is my funding currency? The dollar trend we think will continue, and it probably means for currencies that you may want to short certain emerging markets currencies. We think, for example, in Central Europe, a zloty, a Czech koruna. We think actually the Korean won, Taiwanese dollar, Singapore dollar are shorts against the dollar. We think the higher yielding currencies, Indian rupee, Indonesia, those you want to be long against euro if you can, because this is, we think, where you get the carry and the outperformance.
Very interesting.
That's one theme, the stronger dollar. A theme we haven't touched upon yet, which actually goes in a way, in part hand in hand with the stronger dollar, is the weaker oil. We now, I think, can work with a lower oil price probably well into 2015. And there are winners and losers of that in emerging markets. Huge net and excellent importers. India, again, being an importer, being helped. Markets have been very quick in basically defining the losers. The winners takes a bit longer because the low oil price works itself into macro variables. Again, there I think the trend will be, or the trade in the beginning of the year, is drop in inflation rates. It takes a few months to pass through. You will suddenly have surprises on inflation on the downside. That could then help local bonds, where people anticipate low inflation, possibly rate cuts, and that could then look for people to go into local bonds, which at the moment they'll probably be a bit shy to do. People seem to be a bit more optimistic in terms of thinking there could be positive surprises than they were 1 year ago at this time.
And the consensus is right?
It has not been this year, and I hope next year.
Next year could be an exception. Let's see. Thanks very much, Christian, for joining us and giving us your perspective and your views, your outlook really into the coming year. Appreciate your time.
Thank you. Pleasure.
Well, with that, we come to the end of this edition of Global Mantra Market Outlook 2015. Catch you with another special guest next week. Till then.
Well, it's clear that the US goes into 2015 with a lot of momentum. So I think there we can feel reasonably confident. Europe is perhaps the more interesting case. Europe completely lost momentum in the middle months of this year. And I think we know why that was. It was because the central bank was actually tightening policy, not very visibly, but it was. They were letting interest rates and the exchange rate rise up until about April, May. They then did a U-turn. They've been easing policy, and I think that will give a lot of momentum for Europe into 2015. It won't be the same pace as America, but I think it'll be okay.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.